And yeah, last but not least, we have Andrew and Ed from MHC Fund. If you could just take a first minute to introduce your fund, we'd appreciate it.
Sure, and first I want to say thanks to Ed Choi and the Ternary team for putting on today. It's been excellent, thank you. Hey guys, we are MHC Digital Group. We are a diversified digital asset platform based here in Singapore. Our background is we actually spurned out of our sister company, which is a company called MH Carnegie & Co., an alternative asset manager in Sydney, Australia, with about $1 billion under management. A few years ago, our founder, Mark Carnegie, started looking at opportunities within the crypto sector more broadly, and that spurned the initial foray into building what were our pilot funds, which eventually led into a more diversified digital asset platform. So we put together a team of bankers and investors with a sort of layering on of crypto and Web3 expertise to try and basically bring traditional financial products to the crypto ecosystem. So today we're here actually to talk about our two funds that we've got, the liquid strategies. The first one is the Digital Asset Fund. That is basically intended to provide diversified exposure to the crypto ecosystem. It's a long-short fund combining a number of different products across spot, perps, a number of other derivative strategies, as well as a kind of market-neutral component. And then we also have a separate specific market-neutral strategy combining a number of arbitrage, traditional arbitrage strategies in what we've found to be a very volatile and attractive crypto market. So I think our focus is really to provide a platform for traditional investors to get comfortable with a team and a strategy which is relatively simple on the surface, but provides a kind of safe set of hands to provide a gateway to a small allocation to a sector where we think there's a really strong return profile when you have the right people managing your capital. So that's been our focus, and that's what we're building now. So very grateful to be here today. Thank you.
Hello. Yeah. Certainly, I'm the only old fat banker on this panel. I'm sort of the old TradFi guy who basically worked in financial markets for my entire career, mostly in New York, and got to know crypto and saw it as a generational opportunity. I believe that using traditional finance mechanisms, you can extract value out of a rapidly growing market that has asymmetric risk. And when I say asymmetric risk, I think about if you invest $100 with the volatility in the market, you can lose a good portion of that $100. But there's no market that I know with the liquidity and to a certain degree maturity that offers multiple upsides. So the way I think about it is, yeah, you can lose your $100, but you can make 1,000. So if I can apply traditional finance models and analysis and trading techniques in a very conservative way, with my number one priority being capital retention, I think I can produce really strong returns for myself as one of the two largest investors in the fund, and those that join us to join the fund that we're running. So really, I think there's two things. There's a highly volatile market. It's a new market that I believe is going to transform financial markets as a whole. And that's after a really long, boring career. And number two, if you manage the risk and recognize the asymmetric features of that market, you can produce outsized returns.
Okay, I'm gonna dive into this asymmetrical approach to investing in crypto. You mentioned it a bit there, but can I ask you to elaborate a little bit more, and how is it different from conventional long-short trades in crypto?
Yeah, the way I look at managing a portfolio in an asymmetric market, okay, is the number one priority needs to be protecting the downside. If we look at last year, the crypto market went through a lot of trauma. And, you know, the headline numbers, crypto, like Bitcoin down 70%, and market as a whole down basically 70%. Now, our fund was down 25, 30% over the same period. For me to get back to where I was, if I'm at 70 cents on the dollar, I have to recoup 50%, or I have to increase by 50%. The market as a whole, having lost 70%, has to go from 30 to 100. So therefore, they have to recoup, or the market has to grow 300% to get back to where they started. So in an asymmetric market, it's really important to protect the downside as strongly as possible. Now, we, in our diversified portfolio, at times last year, we had 55% of our portfolio in market neutral strategies. And we vary that concentration with the cycles of the market. And we believe that's how we can outperform.
Also add there, I think that the asymmetric nature of the market is, as Andy says, allows for outsized returns. But I think as a kind of, if you take a step back and have a more macro look at what we're betting on with sector adoption and eventual institutional allocation after regulation catches up to where it needs to be to allow that at scale, we do have a long bias, so that does give us that kind of asymmetric upside. So we do believe that over time, with appropriate management and focus on capital retention and risk management, over time we will achieve outsized returns just because of that kind of long bias to the upside as well.
Okay, so diving into that a little bit more, the collapse of FTX sent shockwaves through the market in 2022. Can you dive into the sorts of strategies your fund uses to mitigate third-party risks?
Yeah, FTX was a big event in crypto. And to be honest, it was a demonstration of centralized players in a decentralized market. When you have centralized players, you have to have trust. When you have trust, you have to have history and capital behind it. And the trust was founded in Sam Bankman-Fried, and unjustifiably so, as he wasn't there wasn't good behavior there. We mitigate our risk by minimizing the exposure that we have on exchanges. We're trading every day. So obviously we use centralized exchanges for best execution, but we minimize the amount that we leave on those exchanges. FTX were our biggest counterparty. We did not lose one penny to the FTX debacle. So by the time FTX had gone bankrupt, we had no money on the exchange. So there's two things there. Make sure you own the custody of the assets. We use multi-signature wallets and the like, and we keep everything as much as possible off exchange. The other thing is you need to be up to date and have someone 24 hours watching the information. We only took everything, literally everything off because we were watching the information.
I'll just add to that, Andy. I'll just add to that as well. We do spend a lot of time assessing credit risk across all counterparties in this sector, and that is a really meaningful consideration for any investor in the space, and certainly as a risk management tool, but also necessarily to figure out the best way to extract value from the market. That credit analysis extends not just to bilateral agreements with OTC counterparties, but also to the exchanges. We spent a lot of time, I mean, we had discussed FTX as a business ad nauseum for months leading up to what happened, and I think, as you can probably imagine, every other exchange was on the radar as well. And we think that our assessment was, in order to access the products, the liquidity, and the opportunities, you need to utilize those mechanisms to trade. But certainly as well, we have to be very conscious that keeping control of your capital as much as possible by bringing it off exchange as quickly as possible is the best way to get exposure to the market without necessarily having exposure to the credit risk of the counterparties in it.
Interesting, a happy story. Your fund sources opportunities in the space which are available through traditional investment products. Can you elaborate on the benefits of this model of deal sourcing?
Yeah, it's crypto people tend to be crypto fanatics and focus entirely on the ecosystem itself. Others create products to make it simple for retail investors and traditional finance investors to participate. One example, you may have heard of the Grayscale Bitcoin Trust, which was a trust created by Grayscale, which houses one Bitcoin for one share of the trust. Now, with the collapse of FTX and others, and others in the space and their bankruptcies, there was some holders that had to sell the assets of the Grayscale Trust. So the Grayscale Trust actually started trading at a massive discount to the Bitcoin itself. The reason for that was supply and demand, not that the trust wasn't backed one for one. So we did a whole load of research to confirm that the trust was backed one for one. And we were able to buy the Grayscale Bitcoin Trust at a 60% discount to, actually 50% discount. The Ethereum Trust was at a 60% discount to the assets itself. So what we did was we sold the Bitcoin that we owned and bought the trust, and through time, we believe that that discount will disappear, and we will have doubled our money, going from a 50% discount to par, plus any appreciation or depreciation in Bitcoin that we would have held anyway. So that's where, using our knowledge of the creation of trust structures in traditional finance and how they work, especially in stress situations, enabled us to identify a pricing anomaly in the market.
Okay. For our audience looking to invest in digital assets, what are the three most important elements of portfolio composition to consider?
Yeah, I think number one is risk management and a conservative stance. And number one priority being capital retention. That would be the top of my list. The second would be holding a diversified portfolio. Now, what you find is that the narrative in crypto hops from one place to another, and stories crop up that are surprises, as with any developing market. So anyone that tells you they know what the next coin that's going to go to 100 times is, is deluded. You have to hold a diversified portfolio in order to maximize the return in a market that is immature in nature and maturing very fast. And you know, the averaging out of the performance across coins will maximize total returns. The third thing in an emerging market is being nimble. So the fact is that the narrative does change very quickly and the stories coming out are 24 hours a day. And 2022 told us that you have to be nimble and not stick to your guns when you hear things coming out. So I'd say don't get overstretched, be diversified, and be nimble.
Okay. Can you explain briefly what DeFi means, using traditional finance as an analogy?
The simple way that I think of DeFi, when you want to transfer money to someone else or across to another country, in traditional finance, you need to have a trusted intermediary. Yeah? So you give the money to someone that you trust and trust that they are going to transfer it over. Becoming trustworthy is a very expensive business. You have to have lots of capital and you have to have been doing it for a very long time. That's an expensive process. Once you've become trusted, you are amongst a very limited number of counterparties who are trusted. So you're able to overcharge for the services that you provide. That's traditional finance, and that's coming from a banker. So, you know, take it from me. I believe that the banks overcharge for the services that they provide, but that they've earned the ability to do that. In DeFi, the computer actually ensures that the transfer is made. There's no intermediary. There's no individual person that you need to trust. You need to trust that the computer program that has been designed to make that transfer has been designed properly. What that means is that you extract that intermediary from the process. And when you extract an overcharging intermediary, you are returning the capital to the user or to the investor. So DeFi takes the intermediary out, thus reducing transaction costs in time, cost, and efficiency. So.
No, I think that's a very good summary. But I think I'll also add that the one thing that we've seen with the last couple of weeks and the fear that's sort of permeating the entire financial services sector at the moment globally is that trust in centralized organizations is kind of being eroded. And what we've actually seen in the digital asset ecosystem, and DeFi specifically, is that DeFi didn't break when when everything else is. And so our view is that trend is that's going to increase the interest in the sector and certainly the interest in the services available through it as a result of what DeFi brings to the table, because the everyday person their trust in the centralized system is eroding because it's clearly not working right now.
Thank you. We just have 1 or 2 minutes left, so I'm going to skip to the end. Everyone is probably dying to know, in your opinion, what does the cryptocurrency market look like moving forward? Are we finally leaving the bear market of 2022 behind? So last question, and then I'll just ask you to do a quick summary.
2022 was tough, that's absolutely sure, and it was a test of the market. If we look at what performed and what didn't. The centralized players suffered. So whenever you look at the bad stories out of crypto, they all come from individuals and corporations misbehaving. Crypto was designed to extract the need for individual players to actually be trusted. So the DeFi system has worked absolutely fine. The centralized system in crypto has not worked fine. You know, whether it's FTX, whatever, where there's human involvement, it's actually fallen down. So we've gone from, you know, what crypto was built for has performed. It's got a track record. The other things that, if we're looking at what's the performance in the next couple of years, if you look at the macro environment, crypto is dependent on liquidity in the macro world. We do feel like the Fed is close to pivoting. I think the markets have pretty much priced that in. But in crypto macro terms, one of the biggest things that's coming, and it's less than a year away, is the Bitcoin halving. Now, the last 3 halvings, crypto has multiplied by more than 100 times. I don't think that happens again. But let's turn around and say it multiplies by a small amount of that. That makes the crypto market a very attractive place to be right now. And let me tell you, everyone will be jumping in when crypto's at 100,000, when they should have been jumping in when it was 25,000.
You want our summary? All right, very quickly. So I guess, like, to summarize this, we've built a couple of funds and a broader platform designed for what we expect to be a small allocation from a well-diversified portfolio of investments for any institutional or wholesale investor. So I think what we've discussed today, being the Digital Asset Fund and the Market Neutral Fund, and the strategies which we have rolled out there, they are expressly designed for people who want to dabble in the sector, but don't necessarily want to go too deep yet because they don't understand it like most people don't. So I think we'd love to have a chat with anyone here today who'd like to discuss investing. And again, I wanted to say thanks again to Ed and the Ternary guys for having us.
Yeah, can I just add, investing in crypto is a journey, and that journey is around getting comfortable with the asset class. We're here to help people along that journey. I've been in it full time for 2.5 years from TradFi. So anyone that wants to take that journey, we're not turning around and saying, listen to me for 20 minutes and that's the end of the story. We want to take people on the journey and help educate people about the crypto universe. So anyone who wants, you know, just more education on the side of things, if nothing else, more than happy to do that. So thank you very much.
Thank you. Thank you to all of our panelists for an excellent discussion on these fascinating opportunities.